Well, welcome everyone to this discussion of the changing rules with respect to leasing. Today, we're really honored to have Rod Hurd with us. Rod, let's see, you actually graduated from Golden Gate in the 1970s, right?
That's correct.
Came back, you taught for us for many years. You were our outstanding faculty. I think there were a few awards in there.
Yes.
Currently, you're CFO of Bridgeway Capital Advisors.
Yes.
But you're also involved with industry groups. Could you explain to me what you're doing with the leasing industry?
Yes. I have been the chair of the Financial Accounting Committee for the Equipment Leasing and Finance Association. And through that committee, we have dialogued extensively over time with the FASB. And what you see in this new pronouncement reflects the benefits of our participation in the process, some of which I will explain as we continue through this interview.
Wonderful. As we go through it, leasing, if we could give a little bit of background. The GAAP rules have been pretty straightforward, right? It's either an operating lease or a financing lease, meaning either you're renting it or you bought it.
Yes, yeah. So what we have in place in accounting, and this was established back in 1976, so you can tell I graduated from Golden Gate just at the time that this pronouncement became live. But under this pronouncement, it classified leases into two types. It's either a capital lease, meaning that it is essentially a financing, similar to secured lending, or it is an operating lease where the lessor is taking a risk regarding the remarketing of the equipment at the end, either by release or resell. So that means those types of leases only provide a temporary use benefit to the lessee. That construct reflects U.S. commercial law. So it is the same construct that is used to determine what are the rights and obligations of the parties in a transaction. And it also then plays out in federal income and state income taxes because they make the same distinction. The consequence of that is that if the lease qualifies as an operating lease, at law they're called true leases, then the lessor gets the benefit of the tax benefits that otherwise go to the lessee as the user. So what has happened is there's been a split between use and ownership provided by commercial law, and the accountants who wrote the original pronouncement, FASB 13 or Topic 840, when they wrote that, they were cognizant of this distinction and they tried to reflect that in the standard.
And this ability to use assets but not have them show up on your balance sheet, it's a huge industry, right?
Yes, it's about a third of the capital expenditures for equipment, for example, are financed with this type of lease. But if you look at debt-like leases as well, you'll find that over half of new equipment purchases are financed on this basis. And most people lease real estate instead of own real estate.
Got it. So we have rules that have been working for 40 years. It seems like a good time to goof things up. Could you talk us through how ASC 842 is going to change our world?
Sure, I'll be glad to do that. And just to give you some background, it took the FASB 6 years to write this new standard, and they had many false starts along the way. But the conceptual underpinnings are 20-odd years in the making. With the Enron crisis and the looking around for off-balance sheet financing arrangements, the SEC reported to the Congress that operating leases should be on the balance sheet and not on the income statement only. And so that provided the genesis for, and this was a 2003 event, for the FASB to pick it up. I was at the trade group at the same time on the committee, and we actually supported that approach, that we thought it was responsive to user concerns about more transparency about leasing commitments. So we have supported it. In our case, it's been about how to do the capitalization. And so the end product that we have now reflects continuity and change. What is different about this standard from a lessee perspective is that all leases must be capitalized, not just those that are debt-like, but also those that are operating in nature. And so if you have a lease that has a term of 1 year or more than 1 year, then the present value of the payments go up on the balance sheet, and there's an offsetting entry to what's called a right-of-use asset. Now, there is a distinction made in presentation between those that are classified as operating leases and classification. So you'll know the difference between the two, and that largely mimics, if you will, what's in commercial law. So the change is what used to be in the footnotes for operating leases is now on the balance sheet, but separately disclosed.
Got it. So in a simplistic world, we took what was in our footnote disclosure, future lease commitments, we brought them up on the liability side, and then because our debits have to equal our credits, we posted a future use of the asset.
Yes.
As the asset.
Now, what then happened is that once you have it on the balance sheet, how do you take it off? How do you amortize it? And so the FASB created a distinction to, again, reflect the difference in commercial law. So for those leases that are treated as debt-like leases, they are amortized in a similar manner, as from the lessee perspective now, in a similar manner to loans. But those leases that are capitalized, that are operating leases, the amortization is linked between the asset and liability such that the income statement continues to reflect straight line, generally, straight line amortization, and it is identified as rent expense. So that is continuity from what we have, and was the most critical decision the FASB made. It distinguishes it from the conclusions made by the international body, but it reflects commercial law.
Got it. As we see that, we had this strong push for convergence between the U.S. and the international community. IFRS 16, does it align?
Yeah, no, the International Accounting Standards Board decided to treat all leases as financings. And I have had the benefit of acting as a consultant in foreign countries and understanding international accounting, and also then understanding business practices. In most foreign countries, they do not have the system of leases that we have, the distinction between operating and capital. And the principal reason for that is in the U.S. we have used equipment markets. We have a propensity for business managers to reuse existing equipment, where that isn't the case in foreign countries. At the same time, our International Trade Association counterpart, Lease Europe, opposed changes to leases, and we think that was a fatal mistake, and why they ended up, both the economic differences between the U.S. and abroad, and also the difference in how our sister trade organization approached the regulators. So I think they got, quote, a bad outcome.
Got it. So now we've got just a change in how we report things, a little bit more transparency. Anybody using our financial statement sees that liability. What could possibly go wrong? Could you talk about the impact in the real world?
Yes, and now here's the curious part. Credit rating agencies have been capitalizing leases for many years, probably 20 plus years. As far as they're concerned, the additional disclosures are valuable information. The calculations are of interest, but their methodologies they consider to be superior. So what they're going to do, this is like Moody's and Fitch and S&P, they're going to remove the amounts capitalized under GAAP and put their own back in to do the calculations. So it's a no-change environment for them. They do say they will have more precision now in their calculations based on the incremental information that's provided, but it has not caused them to say, we're out of business because the FASB's done the work we needed to do. So that's one perspective. The other interesting perspective came from the American Accounting Association in a report just prior to the issuance of this new standard, where they found that incremental disclosures, as opposed to on-balance sheet reporting, would equally serve the users. So the question is, did the FASB end up with a higher cost solution than was otherwise available?
Designed by a committee. I think the answer to that one's yes.
Yes.
Got it. And then in terms of what you see as the impact, for example, to bank covenants, what should our Alumni be talking to their clients about today?
Yeah, so this is a very interesting area because it's taken a while for the banks to understand the concepts and the differences in the accounting. In the basis of conclusions, the FASB makes very clear that the operating lease obligation that is capitalized is, quote, not debt. It is an operating expense, and therefore it should not affect debt covenants. And they also make the observations that many of the debt covenants say just because the accounting changes, that doesn't mean that the results change. That there's accounting changes are generally protected in debt covenants. Nonetheless, if you look at some of the definitions of tangible net worth, you could find some perverse effects. For example, you could have the asset, all right, that is capitalized as an allowable asset under tangible net worth, depending upon how you view the right of use asset. But then if the FASB says that the liability is not debt, then you're actually going to increase your tangible net worth, which is not what lenders want to see. They want a no change environment. However, I will say this, whenever there is a change, banks and other financial institutions sometimes take advantage of those changes to re-examine customers they otherwise would prefer not to continue with, and to use that as a basis to either get fee income for making changes or to term out the relationship. So you have to prepare. Despite what the FASB has said, in practice, there's going to be some dynamics around debt covenant negotiations.
Got it. And as you think about what the practitioners you're seeing out there are advising their clients to do today, this change doesn't come into effect for a year or two yet, right?
Yeah, and it's 2019 for public reporting companies, with look-backs to 2017 because you have to do comparable financials, although there are some practical expedients to minimize the amount of look-back work. For private companies and not-for-profits, it's 1 year later, or 2020. However, here's the rest of the story. In 2018, public companies have to do revenue recognition implementation.
Right.
And then in 2020, they have to do credit impairment changes because there's another standard that's out there. The question is this triple play, revenue recognition, leases, and credit impairment, too much for preparers to handle?
Right, and actually in this coming year, 2017, don't we have the change from lower of cost or market? So our cost of goods sold, the second biggest number on our P&L,
Yes.
I think is getting bumped around as well.
Yes, that's correct. The good news from the perspective of Golden Gate is that there's a lot of career opportunities for accountants. And unlike people like me, I have to unlearn what I've learned before, where the new students just learn it fresh.
Let's hope that they learn it not only fresh, but they learn it with the industry perspective. What do you think is going to be the impact on the American leasing industry?
I think it's fairly positive. I was at an annual convention last week with marketing officers, and they feel this has resolved uncertainty about leases and kind of the reputational problem about off-balance sheet financing, because it is an essential way to match cash flows. A commonly leased asset is an airplane. And they do that because they can't use all the tax benefits because airplanes, are 100 million plus, but they want to match their cash flows. So a small business is the same. How do you get capital 100% advanced for you to have assets to use in your equipment? So the fundamentals are sound. And so people feel that the change in accounting, along with the recognition of the FASB that operating leases are different than finance leases, has created a positive attitude in the market.
Good to hear. And what's the impact on sale-leaseback transactions?
Well, this is a problem. Okay, so, and this is where an interdisciplinary approach is kind of useful. Under current rules for GAAP, sale-leaseback transactions can be treated separately, separate legs. So you can treat the sale, if it meets sale criteria, separate from the leaseback. Under the new rules, there's much more situations where it's going to be treated integrated, and I won't get into all of the detail because it's pretty daunting. But anyway, they can be treated as a financing. So more transactions will end up being treated as financings under the new rule compared to the old rule. At the same time, though, they have, at the FASB, reduced the situations that cause deemed ownership by the lessee prior to the delivery of the asset. So I can tell you that the legal community has said we can write contracts to avoid tripping sale-leaseback accounting. And most of the accountants I talk to think that they're going to be able to do that. So it's an incremental cost, but it is something that can be accomplished. And so again, there's kind of a positive view about avoiding the change.
Got it. And from a tax perspective, we have traditional rules, Code Section 467, that talks about long-term leases. How are these changes going to impact the taxation of leasing transactions?
Well, there should be no change. I mean, you're going to have different book tax differences, and therefore your deferred tax accounting is going to change. But none of this, causes, at least on implementation, a change in tax law. However, whenever one discipline moves, it is generally the case another discipline ends up moving symmetrically, particularly if there's a revenue-raising opportunity. So, for example, the capitalized right-of-use asset may attract incremental property taxes.
Right.
And then at the end of the day, it may change how the Congress views the transfer of tax benefits, under what circumstances that should be allowed. So, not currently, but I think strategically it's going to be an issue.
Wonderful. Thank you.